Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. Gosh, we got some great things to help you understand more about investing, the economy. We're going to kick it off with, we have gone through 4 industrial revolutions in the U.S., but why does the AI revolution scare us the most? We'll talk about that. And Bitcoin Holder Strategy, that's a company, used to be MicroStrategy, should be getting nervous about the price of Bitcoin. We'll discuss that. And then also, too, surprising, you hear about how bad the consumer is and the economy and so forth. But holiday shopping, well, it's hit record levels. We'll talk about that as well. And then we've got some companies we're going over as also.
Yeah, companies we're going to look at today includes Energizer Holdings. I saw this one pop up. They reported some earnings. And I'm like, I've never looked at it, but always know the brand name, the Energizer Bunny. So excited to see if the fundamentals look strong on that one. Also, too, Netflix, they won, so far, they won the sweepstakes for Warner Brothers Discovery. And then we'll look at Valvoline and Weyerhaeuser as well. And as always, break down the fundamentals, give you an idea if we think it's a buy, sell, or hold based off the numbers we see here.
And those are two companies, Valvoline and Weyerhaeuser, two different companies. Wait, it sounded like Valvoline and Weyerhaeuser, but yeah.
Two different ones.
Two different ones, okay. Well, let's talk about Bitcoin Holder Strategy. Should be getting nervous about the price of Bitcoin. The public company strategy, and again, it's a public company, used to be MicroStrategy. Trades under the symbol MSTR, should be getting nervous because it has about 650,000 Bitcoins that are worth around, depending on the day, because it goes up and down a lot, Bitcoin does, about $56 billion. The problem is the company has about $8 billion of convertible bonds outstanding that require interest payments, and also about $7.6 billion of perpetual preferred stock that also pays dividends.
The problem here is the cost to pay the interest in these dividends is about $780 million annually. And since all the company's assets are essentially in Bitcoin, they don't receive any interest or profits from that asset. And I don't really think they have any other business lines. I know they were a different type of business before the Bitcoin thing, but I think they were a tiny, tiny business. So yeah. I don't think they really have any profits outside of that. The CEO, Michael Slayer, is saying if they have to, they will sell Bitcoin to raise the cash to pay the dividends and interest payments. The convertible bonds could also be problematic down the road, as they are due in about 4.4 years on average and come with a combined interest rate of 0.421%. I was going to say, that is an extremely low interest rate. And this is, again, kind of part of the hype. They're able to get such a low interest rate out of the hopes that people would get a favorable exercise price. And I'd be very curious what the conversion price is on those convertible bonds.
And I think that is public information. I have to dig for it, but I'm pretty sure that has to be there. And the problem is, obviously, if everybody converts, you've got all these problems with dilutions, and then if they sell,
I think that's the least of their problems. I think they should hope and pray that the people convert. And I say that because if they don't, they want their money back. They don't have the money.
Well, and I guess no matter what you do, it's a problem, because if they convert, they're going to dilute the shares, and then they sell. If they don't convert, then they're going to want their money back. Either way, it's a no-win situation. And this was great when it started, because look at, we're buying all this Bitcoin. And the thing that's always irritated me about strategy, they're not doing anything. Anybody can go in and just buy Bitcoin, and anybody can just go in and float debt or sell stock. They're not creating anything of use to anybody. It's just very frustrating. And because of this, the stock, itself has been pulverized, and its market cap has been as low as $49 billion. And that was a high back in July of $128 billion. That's almost a third of the value. Now, MSCI has proposed cutting digital asset treasury companies from its indexes if crypto tokens make up a major part of their assets. And they don't say what a major part is, but I know that, again, we've talked about Bitcoin is probably like 90% of their assets. It has to be. This decision will come in a little over a month on January 15th. And if this happens, Strategy could see $2.8 billion in passive outflows of people saying, well, not in the index, so we got to sell it now.
Yeah, I mean, and it's not even like I want to sell it. You have to sell it because the indexes would sell it. The other thing, too, JP Morgan does estimate that about $9 billion of the company's market cap is tied to passive and index ETFs and mutual funds. This could then put even more pressure on the stock if more indexes also decide to remove these treasury companies. So you talk about MSCI, but if there are other indexes that kind of follow their lead, that's where, again, $9 billion could be at risk.
Yeah, and MSCI used to be Morgan Stanley, I forget what the C stood for, indexes. And for some reason, they dropped that name. It's just now MSCI, but they do these indexes, many different indexes. So it's very important. It's a major index they're talking about. But you won't believe, and another thing about this company, you won't believe how the company does their profit and loss statement, their P&L. When the price of Bitcoin rises, hey, yes, everything's great. The company can book a paper profit, even if it did not sell any Bitcoin. Now, on the other side, the problem they're going to have is that if Bitcoin goes down in value, like it has for the past, month or two, they must book the losses as well. So guess what's going to be the next quarter look like come December 31st if Bitcoin doesn't go up dramatically, which I don't see why that would happen.
Yeah, we'd see some nice negatives there. One has to love the estimates, though, for the earnings of Strategy for 2025. Strategy is expected to report a loss of $5.5 billion or a profit of $6.3 billion or something in between. Now, that is just some great guidance, I got to say. And I don't know where Bitcoin is going today, tomorrow, or anytime in the future, but I would just be sweating bullets here if I held Bitcoin or Strategy in my clients' portfolios or even my own portfolio. I would never buy anything like this.
No. And we've talked about that for years, and it makes no sense. And we don't know where the top or the bottom is for it. But fundamentally it makes no sense. And this could be the end of it because, and not the end of it, it will always be around in some form. But if Strategy, their stock continues to drop and they have to start liquidating their Bitcoin, that's going to put more pressure on the downside for Bitcoin. And then other companies, we've seen a little bit of it, other companies that have it in their treasury, they've had to sell because they're underwater. And I believe that Strategy is very close to break even. And the CEO, Michael Slayer, has said that, we would start selling if we start losing money on it.
Well, and I did find some notes here. It looks like a couple different convertibles did pop up, and it looks like one set of convertibles, their conversion price is $433.43, and the other conversion price is $672 per share. Right now, and this is 2029 and 2030 is when those notes come due. So right now, Strategy's at $178.99. The way that convertible bond works is if I'm going to use the $433 example here, let's say Strategy's at 500. Well, yeah, absolutely, you're going to want to do the conversion because then you make a nice profit off that.
Right.
But if Strategy's still at $200 a share, let's say, and the conversion price is 433, well, what the bondholders would do is say, give me my cash back.
Yeah.
And the problem here is this is where you said, well, the dilution's a problem. I said, I think that's the best case scenario for them is dilution, because if they have to now come up with cash to pay those bonds and they were way off on the conversion price, they're not going to be able to issue more convertible bonds at a favorable rate. They're going to have to sell Bitcoin to pay off that debt. And I think that creates a cascade effect because now they have to sell Bitcoin. Bitcoin goes lower. What is this company tied to? Bitcoin.
So and then it goes lower.
It's just not a, I think, viable company, obviously, and I think it's a house of cards.
And you said the conversion price, I think one was 400. Was the other 700?
433 and 672.
I think it's been as high as 400, I believe, but I don't think it's ever been as high as 600.
I don't believe so.
Yeah, I don't have a chart pulled up on me.
And this is, again, just quick Google research, so I didn't have time to actually go into the details, so let's hope Google's not feeding me some nonsense here on the conversion.
No, I pretty much trust that's a pretty reliable source, but it still does cause a problem for Strategy and Bitcoin. And again, and this could all unfold next year. We talked about January 15th. If they say, no, we're going to kick you out of the index, that could start the problem. And people might, and they can actually sell, well, they can't redeem them, but they could sell the converts on the open market as well. But that wouldn't hurt because it's 4.4 years.
I think there's just so many problems with this. And this is why, again, having an asset that does not produce cash flow, to me, is useless.
Yeah.
I want assets to produce cash flow. Bitcoin, no cash flow.
And we'll be talking about later on the lumber company Weyerhaeuser. which is an asset company, but we'll talk about the differences of that. So let's talk about holiday shopping hits record levels. We continue to see conflicting data when it comes to the health of the consumer. They continue to say they don't feel good. The consumer, I'm kind of nervous and so forth. But our data and the actual numbers remain quite strong. In a positive note from the National Retail Federation, the NRF, an estimated 202.9 million consumers shopped during the 5-day stretch from Thanksgiving Day through Cyber Monday. That is the largest turnout since the data for the 5-year period started being collected back in 2017. And it easily tops last year's level of 197 million shoppers. Expectations for the period were also quite low, considering the estimate was for just 186.9 million shoppers. So people are, again, we've said this, they're saying one thing and they're voting with their pocketbooks, doing something else.
Yeah, and when you look at this, online shoppers, it seems, again, that's really continues to grow in popularity. They increased 9% year over year to 134.9 million people. But in-store shoppers also still saw a nice increase of 3% to 129.5 million people. Adobe, well, they also provided sales data for the 5-day period that indicated consumers spent $44.2 billion online, which was a 7.7% jump year over year. Black Friday in particular saw strong online sales as they totaled $11.8 billion and grew by 9.1% year over year. So very nice growth rates in terms of the sales figures, because obviously you see the number of shoppers, but I think the absolute dollar sales is almost more important than the number of shoppers.
I think so too. And a big question here is, if the shopping was done to capitalize on deals and attempt to save money, well, that could be an indicator of a weaker economy, people trying to get the deals ahead of time. But I don't believe that's a full story. As shoppers told the NRF at the end of Cyber Monday, they had about 53% of their holiday shopping still to do, which was similar to a year ago. So they're not even halfway done yet.
Yeah, and I think this is an important note because, if people are exercising and looking for those deals, that could, again, be that negative indicator of like, well, I'm going to do all my Christmas shopping when I can get great discounts. Where if it's like, well, it's just not really convenient for me to do it during that time period, that's, I think, a signal of a very, very healthy economy, because it's like, I don't care about the deals. It's whatever's convenient.
And what all happens too, as you get closer to Christmas, you really get that holiday feeling. You're like, oh, I don't care about it. I'm going to spend a little bit more money. I feel so good. So that can obviously change as we get closer to the true holiday season.
Yeah, and I mean, kind of speaking to the true holiday season, I mean, these full numbers from the NRF, they really kind of blew me away. For the full holiday season, they do expect record sales of between $1.1 to $1.2 trillion. And that period is from November 1st through December 31st. This would be the first time sales would top $1 trillion, and it would represent a 3.7 to 4.2% increase from the year ago holiday period.
Think about that. That's a lot of money, $1.1 to $1.2 trillion. And I just wrote a post for next week, which we'll probably talk about. It'll be in the newsletter, about the U.S. consumer. It really does have an addiction to shopping. And I discuss more about that in the newsletter for next week. And we'll probably talk about on the radio show as well, perhaps. But it's just something that there are people, and you do actually get, there are people that actually do get dopamine.
That is actually in the newsletter this week.
Is it this week?
It is this week.
Oh, I thought I just wrote it. I guess we put it in quicker than I thought.
Yeah.
Well, we'll have to. Well, I'll promote that to make sure people get the newsletter. If you don't get it, you got to sign up for it. Let's see. We got one more here.
We do have one more topic.
Oh yes, we do. This is an important one as well. I mean, everything we talk about is trying to important, make you a smarter investor. But we have gone through 4 industrial revolutions in the U.S. Why does the AI revolution scare people the most? Well, industrial revolutions are nothing new in the United States. We have gone through 4, including the current one that we're in. And yes, it's an industrial revolution. The first one came in the mid-18th century when changes came for water power, steam engines, and textile manufacturing. The second industrial revolution was in the 19th century, the mid-19th century, when steel became a big factor along with electricity and mass production. And that kind of scared people too about their jobs, because mass production, like, oh, they need less people. So that scared people quite a bit. We also saw transportation by railroads and automobiles during this revolution. The third industrial revolution came around about the mid-1990s. And some of us who are 50 years or older may remember the effects electronics, including personal computers, information technology, and this scary thing came out called the World Wide Web were developed during this revolution.
As I said, the fourth industrial revolution is happening now, and it's scary because we don't know what the future holds. This revolution includes digital, physical, and biological technologies. This includes AI, the Internet of Things, and robotics as well. The reason this is scarier than the third revolution with personal computers was that people could see how they could benefit and get more done and maybe use that computer to start a web-based business. Currently, with AI, people are not seeing how it will benefit or improve their lives, but only how it could take away their livelihood by making their job obsolete. And, kind of looking at the World Wide Web, I mean, gosh, it is just so crazy, the efficiencies that came about from that. And I just sometimes do wonder if people's like, oh, AI is so much. And I'm like, I don't know. I mean, it has to be pretty crazy to beat the World Wide Web.
Well, and also, too, I do remember that time frame that people were kind of concerned as well because the internet, there was talk about, yes, these computers are going to take away, and it did. It saved a lot of time like AI is, but this one seems a little bit different because we don't know, and it always feels different until you know it. Point being that it could turn out to be better than we think, making us more efficient, but there could be a slowdown also in the advancement of AI, similar to what happened in the late 70s with nuclear power. People as a whole rejected nuclear power, and it has taken almost 50 years to be accepted, which you can now see in today's newspapers. You'll see more about nuclear power. It's coming back, but a 50-year time frame to get back because people reject something as a whole. It's just not going to come into that. So if we do the same thing with AI, it's going to slow down.
Yeah, and I mean, you kind of look based on history, it looks like the acceptance of AI may slow down because polls show that just 40% of people said that the AI industry could be trusted to do the right thing, and then 57% say the government needs more regulation on tech and AI. Maybe your job is safe for longer than you thought, as again, this AI push could maybe be peaking.
Yeah, and that's what we're thinking. But what's not slowing down is the investment, the borrowing, and everything that's going into it. And this is why we talk about, yes, it is here to stay, it'll be here. But the pace, and we've talked about this in the past as well, where how fast they tried to build the internet with all those, what do they call them, dark cables and everything. They overbuilt too quickly. Happens in many things. In real estate, we've talked about apartments, the same thing. They're building so many apartments. Well, you're way ahead of the time, and eventually they will be full. But this is why we talk about from the investing side, be careful of overpaying for any investment that is just like way overpriced because, and we've talked again, and we'll always remind people, it took Microsoft, 15 years to get back to break even, I think it was.
Yeah. And I mean, the thing that I kind of look at too is with these data centers, you kind of talk about the cables, I'm going to use the Chinese real estate act because they actually called them ghost cities where, you have this. I think you could have ghost data centers. And the big problem is this still has an impact on people. And this is why I think people are starting to get frustrated with it is the energy and the cost associated with these data centers are getting so crazy. I think in Virginia, they've seen electricity costs rise about 20% year over year. So people are like, whoa, what the heck? Like, I don't want to pay for this. And I think there's just this kind of public pushback as well at times. And if you live around a data center, I've seen some videos of, and you don't know how fabricated they are, right? Of like, oh my gosh, this is all changed. Now my water's not as clean. I mean, if it is truly having this impact on society that's not as positive as people want it to be, you're going to have this negative reaction to it. And that's where that slowdown could occur. And I just think, as you said, that overinvestment could, again, lead to a lot of people losing more money than they thought was possible.
Yeah. And that's what we talked about. People say, gosh, you guys are a very common sense approach when it comes to investing. And that's what it's about. I mean, investing, it is difficult because you're trying to invest for the future. But you got to have common sense. You can't just buy something just because AI, that didn't work out very well with .com either, or nuclear power back in the 70s. So this is why we talk about this, to try and make you a smarter investor so you can build your long-term wealth.
What is funny, the only reason that nuclear power has come back into play is because of AI, because we need power. I don't think if we would have had AI, I don't think we would have had this push back towards nuclear power.
You're right. You're right. But things keep changing. All this information does come from our newsletter. It goes out every Friday at 5 o'clock by email. It is free. Other topics we talked about, it may not be a great deal. It may not be a great deal to take advantage of that builder's cheap home loan. We talk about that in the newsletter. Rising costs are starting to weigh on the middle-class consumer. AI spending, currently unrealistic. We've kind of talked about that. Berkshire Hathaway, well, they sold more Apple stock. Will California ever get out from underneath all the debt they have? I saw this. We generally don't rate too much about California, but you see these numbers, and I know that the governor is going to be probably running for president, and you have to look at what he's done to California. And then the U.S., here it is, you're right, the U.S. consumer is addicted to shopping. That was so much fun to write that one because it was just like amazing, some of the numbers. And we do give in the newsletter ways to get away from it, how to be unaddicted. You may not like the solutions, but they're real. Yeah, Sarah shaking her head. No, I didn't like what you said about that. We'll say that for the newsletter. Sign up at the website, smartinvesting2000.com. Again, smartinvesting2000.com. It is free. Goes out every Friday at 5 o'clock. All right. So we're talking about the company is actually ENR, but it is also called Energizer Holdings.
Oh, yours shows up as interesting. Yeah.
What does yours show up?
Energizer.
Oh, okay. Energizer Holdings in parentheses, but insight for ENR. So, but
yeah, mine just says Energizer.
Okay. Well, we'll call it Energizer Holdings. That sounds better.
Yeah, I think more people will recognize that.
All right. We're talking about the Energizer Bunny, but they are in the industry of electrical equipment and parts. And I'm kind of curious here. I thought they were just batteries. A lot of short on the float here. 13.1% short. We do see that the PE ratio looks very good, 5.5, about half the industry at 10.3. Price of sales, very good, 0.4 versus 3.2. Price of book value, 7.3 versus 5.6. These are valuation ratios. You do want them lower than the industry average. However, price of cash looks great at 8.9 versus 23.9. And then the PEG ratio tells you the price earnings divided by growth, what you're paying for the future growth. Very good for Energizer Holdings, 0.5 versus 124 for the industry. Now, over the past year, the earnings are up 38.5%. The industry was down 21, but I think there had to be some accounting things there or a terrible previous year. You can't grow your earnings at 538%, especially when sales were only up 2.3%. Industry was up 74%. The 5-year growth rate for Energizer Holding from the analysts shows to be 13.4%. So that's a pretty good number there going forward. They pay a nice dividend here, 6.6%, and will only use 35.6% of the earnings to pay that out. Now, when you look at the free cash flow payout ratio, not quite as good, 136%, but a payout ratio of 36%, pretty good. So I'm kind of liking what maybe we see here, but let me turn the balance sheet, see if there's a problem here. Oh, yep, here it is. Here's a problem. Current ratio, 2.1 versus 2. That's great. They have a lot of liquidity. Debt to equity, 20.8 versus 0.6. That means their debt is 21 times the value of their equity. So I'll look at the balance sheet. Maybe I look at a couple other things, see if I can figure something out there. Intangible assets are high at 41.1%. Let's see. Net profit margin looks good, 8.1 versus 7.5. Return on equity, and here, this could be why the debt to equity is so high. The return on equity is 140.7%. So maybe they have a very small amount of equity. Return on invested capital looks more reasonable at 10.2%. Free cash flow, not very good. It's only $63 million. The industry's at $3.9 billion. What do you got going for it, Chase?
Yeah, I was just kind of surprised by this on Energizer Holdings, and I think the reason it's not just Energizer is they do have different things. I mean, they have Rayovac, which is another battery company. Yeah. I remember seeing them. But they also have auto care brands, which I was kind of surprised by.
Auto care brands?
They have like Armor All, like I've seen them for like the cleaning and so forth. They have California Scents, New Finish, Refresh Your Car, Eagle One. So, I mean, they have some other business lines that I would have never guessed that Energizer was in.
Yeah, and they probably have tried to diversify the business, which could be good, but it could be bad. To buy those businesses, they may have used a lot of debt to do it. So.
And that's probably what's driven up those intangible assets, is buying all those different companies. But looking at the current price here for Energizer Holdings, again, their ticker symbol is ENR. It's $18.21, 52-week range here. The low, $16.77, and the high, $39.06. I see over the last year, the stock is down 53%. Over the last 5 years, gosh, not well at all, down 57%. And over the last 10 years, down about 47%. So have not been favorable to hold Energizer for the long term here. Looking forward for the company, though, I mean, the valuations look very strong. You go out to September 2027, estimated earnings per share of $3.85. They give you a target sell price of $63.91. The stock trades at under 5 times those future earnings.
I'm looking at the balance sheet right here. That's why I'm kind of pausing and trying to figure this out. It probably takes a little more research because the debt doesn't look bad. The debt's $3.5 billion. That's the same as it was 2022. It went down a little bit after that, but again, about the same as it was about 4 or 5 years ago. The problem appears to be in the equity. They only have $170 million in equity, which is higher than back in 2022 at 131 million. But the problem that we have is that, your assets minus liabilities gives you your shareholders' equity. Also, their liabilities are pretty high. The liabilities are about $4.4 billion, most of which is debt. So, but they seem to have great cash flow, then they can service the debt. I want to buy this company, but I got a little bit nervous when you're talking about the different brands they have, which can kind of mean sometimes a company gets too diversified and they can't control the business. Maybe that's happening here. I'm going to look at the cash flow.
Well, it's just odd. I mean, I kind of pulled this up. The batteries and lights occupy about $2.3 billion worth of revenue. Batteries, they do lights too.
Like light bulbs or light LED?
I don't know. It just says lights.
Okay. All right.
Yeah. But then auto care is $620 million. So it's like, why would you even get into auto care? And you're not specialized in that.
Yeah.
So I think that was a mistake. And I mean, the only thing I'm not sure of is, battery usage. Is that going up or down? Me personally, I know I used to use a lot more batteries because I played video games and I had to change out my controller all the time. And I'm like, I can't even remember the last time I bought batteries.
Well, I know my wife, Christina, she's actually decorating the house, and a lot of things you buy now, the lights, they work by battery. So she went to Costco and bought a big thing of AAA and AA because now some holiday lights, they don't plug them in the wall anymore. They just do by battery. So I don't know.
Maybe battery usage is going up.
I don't know. But I don't like the cash flow of the company either. It's like $147 million. So as much as I want to like this company, I just can't. Yeah, too many concerns there. So
yeah, it's definitely a disappointment. Especially, I love the Energizer Bunny. I thought
I do too.
It's kind of a iconic symbol there. But as you said, debt just will always take you away from a potential business there.
Exactly. All right, break is coming up. So when we come back, we'll talk about Netflix, Valvoline, and Weyerhaeuser, the lumber company. Stay with us. You listen to Smart Investing Show with Brent and Chase. We'll be right back. All righty, welcome back to the Smart Investing Show. It's now time for financial planning. For that, we always turn to our financial planning expert, Harrison Johnson, CFP. Today, I like this topic because it is December, and we actually do this throughout the year. But you're saying when tax loss harvesting makes sense and when it doesn't. It doesn't always make sense, does it?
It doesn't always make sense, and I mean, it depends on the situation, and I'll kind of go through when it might make sense. So, for example, if you can use a tax loss harvest or use a tax loss to offset some gains that might bring you down into a lower tax bracket, that could be a good time to do it. If you're going to trigger some IRMA through your Medicare premiums, if you could bring your income down to avoid that, that could be helpful. If you have some short-term gains, you can maybe use some losses to offset those. Even long-term losses can offset short-term gains if you don't have any other long-term gains. So short-term gains are taxed at a higher rate, so that might be worth offsetting. But just because you have a loss in something doesn't mean it is a good thing to harvest that loss. A big part of what you need to look at is not the dollar amount of loss that you have, but the percentage of loss that you have. So for example, I've got some numbers here and I'm going to try and not keep it too wordy, but let's say you invested $50,000 into something and then it's declined to $45,000. So $5,000 loss, which is in this case 10%. If you're in California and you're in the 15% tax bracket, your all-in marginal tax rate might be 24.3%. So if you harvest that loss, your tax savings is about $1,200, a little over $1,200. However, you'd have to sell all $45,000 to save that $1,200 in taxes, which means that $45,000 investment only needs to appreciate by 2.7% to completely offset the tax benefit that you have there. So with wash sale rules, you can't rebuy something within 30 days. So it's very possible that that investment could appreciate a whole lot more than 2.7%, especially if it's a good investment. So in that case, it's only a 10% loss might not make sense. However, let's say you had a $10,000 investment and it declined to $5,000. So now it's still a $5,000 loss, but it's 50%. In that case, assuming the same tax bracket, still saves you $1,200, but that now $5,000 investment would have needed to appreciate by 24% to recoup that tax loss saving. So a lot of times it comes down to what is the percentage loss that you have, not the dollar amount loss that you have.
Right. And it's so important because I know I agree with people. I hate paying taxes, but you don't just sell something just so you don't pay taxes because there's so many problems going to happen. And from the investment side, we look at too saying, I have seen investments rebound. I mean, the reason why the stock dropped could have been a temporary thing, and all of a sudden it rebounds, and then it goes up, and you sold it, and it goes up to, up 20, 30%. Well, if you buy it back after that 31 days, you then have a short-term gain when it does hit the target sell price. So there's so many factors that people don't understand about tax loss harvesting. They think, oh, it's a great thing. I know sometimes CPAs, accountants say, oh, it's a great thing. You've got to understand all the fundamentals. And you talk about all these other things too that you have to look at. It's not just a one thing you look at not paying taxes.
Yeah, exactly. I mean, no one likes to pay taxes. Even if, like you said, if it goes up, you saved $1,200 in taxes, but maybe you missed out on a $5,000 appreciation because that position went up by a few percent. But even if it doesn't, even if you sell, and in this case it was $45,000, and then you buy back and it's still the same amount, well, in that case, you reset your cost basis. So if it ever does rebound, now you have a larger gain in the future. There is some value to tax deferral, but depending on your tax situation, that might not actually be helpful. In people who are in retirement over the age of 65, your income can be up to like $150,000, and long-term capital gains are taxed at 0% federally. So harvesting a loss might do nothing because the gains that you have might be tax-free already. And so you definitely don't want to harvest a loss and then reduce your cost basis and then sell that position at some point in the future if you do happen to be in a higher tax bracket at that point. So you need to look at, what bracket are you now? What bracket are you later? What is the all-in benefit of harvesting a loss? And then what is the future consequence of that? And then, what could those investments be doing in the meantime?
The other thing, too, people don't understand also, and I'll let you go in a second, Chase, is that if you do buy back in 31 days, okay, great, fine. But you may have held that company for maybe 10, 12, maybe 2 years. You had a long-term gain. But then you buy it back after 31 days. Then it hits its target sell price 8 months down the road. Time to sell it because it's target sell price. Now you have a short-term gain.
Mm-hmm. Yeah, exactly. Now taxed at a higher rate. And so, the tax loss benefit that you have, when you harvest a loss, in many cases, the benefit is really a long-term gain that you're offsetting. So then if you have to realize something at a short-term gain, that definitely more than offsets it, or you have to continue holding something because you don't want to pay the short-term gain, well, then, maybe it becomes too risky at that point and it goes down. So there's a lot of different factors that go into it, and it's not as simple as just, well, I have this loss and I'm going to use it to offset my gains. Really might not be the right thing to do. Sometimes it is, but not always.
Yeah, I was going to say, I was having a conversation with a gentleman today, and he was talking about he had this company, it was CoreWeave actually, got in early, and it went up to 160. He's like, I was going to sell it at 160, but people are like, don't sell it because it's a short-term gain. I think now it's at 80. He's like, I wish I would have sold it. People get so fixated on, again, the taxation of it rather than the economic value of that business. And they will make that tax decision at their primary driving force as to how they're going to respond to buy and sell in different situations. And when we look at tax deferral, I really believe tax deferral is great for IRAs, for 401ks, because you can have a diversified portfolio that is growing tax deferred. With individual stocks, you don't really get a benefit from tax deferral.
It's not the same, and it's a good point to bring up because tax deferral is helpful when you know you're going to have compounding growth, which in an overall account, that's normal. If you have a diversified portfolio in an IRA, the tax deferral is helpful because those gains can be fully reinvested without tax. So the tax benefit is there. When you have an individual position, individual positions don't always go up over time. So like in that example of CoreWeave, yeah, you would have liked to defer the gain, but there's no guarantee that it's going to continue going up, especially when you hold something risky like that. So yeah, in that case, it would have been much better to pay the taxes, take the gain, and move on to something else. And that's also a problem when you're investing in something that's speculative, because you have that fear of, well, I want to wait 12 months so I can lock in the long-term gain, but that means you have to continue holding that risk essentially. And in that case, a lot of cases it doesn't work out.
And there's some cases where you could be 22% tax bracket federally, and then
for
you'd
ordinary
be
income,
15% capital gains.
Yeah.
State of California, it's the same regardless of your taxation. So it's like you could be saving 7% potentially.
Good point. Long-term gains are always going to be taxed at a lower rate than their short-term gain counterpart, but you're right. In many cases, it's not that different. Both short and long-term are subject to the net investment income tax. If your AGI is above a certain level, both of them can trigger IRMA. States do not differentiate between long-term and short-term gains. They're all taxed the same. So yeah, you might be 15 versus 12, or you might be 0 versus 12, or you might be, whatever it is. But you're right. The actual real benefit of a short versus long-term gain might not be as helpful as you think.
There's a lot more to it than people think. And one thing I learned many, many years ago, and we apply here at Wilsey Asset Management, is never make a tax decision over an economic decision. You've got to look at the whole situation. You can't just say, sell it because I want to take the loss. You can't do that.
Yeah. I mean, sometimes people don't like to hear that, but at the end of the day, you want to make money, and you want to mitigate your tax bill on that, making money as much as possible, but you don't want to lose, much more than whatever tax consequence might be there.
Takes a little time. Can't do it a quick decision.
Yeah.
All right. Harrison, thank you very much. Again, that's Harrison Johnson, our financial planner here at Wilsey Asset Management. He's a CFP. If you want to talk to him or have a consultation with him, give a call here at the office at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Send an email. You can have that free consultation with him, and maybe you're taking taxes you shouldn't be, or not taking taxes you should be. You got to be careful. It's not an easy thing. It's just not.
No, I mean, it's tough. As you said, nobody likes paying taxes.
No.
But sometimes you have to.
You have to, because the economic benefit is better to pay the taxes than not. And you made a great point with that CoreWeave, gentlemen.
And then we have one client. He always calls taxes a champagne problem because you're not going to go broke paying taxes.
Right. Yeah. And I would rather make money and pay a lot of taxes than make no money and pay no taxes. Yeah. So, all right. Should we move on to Netflix?
Let's do it.
All righty. Well, Netflix, big news today was they are looking at, they haven't done it yet. They're looking at, it's a deal they put out there to buy Warner Brothers.
Well, their deal was accepted. It's just a question of if it will be approved.
If it's approved, and that's the thing. So it's not a done deal, but they made the offer. So the offer is there. Now they go through all the
the offer is accepted.
Yeah, but now they have to go through the regulatory.
Yeah.
So it may be accepted, but it may not go through. So we'll talk more about that. Let's talk about the numbers if you should buy Netflix here. They're in the entertainment industry. Only short is about 3.5%. People love Netflix. I use it myself, one of the products I use. We do see, unfortunately, they're very expensive. PE ratio is 41.9 versus not material for the industry. And the industry, again, is the entertainment industry. We do see price of sales are expensive, 10.1 versus 2.1. Price to book value is 16.4 versus 3.4. And price of cash flow, 45.6 versus not material for the industry. Now, this is amazing. I mean, those numbers are very high. But their PEG ratio, which is your price earnings divided by growth going forward, is very good. It's 0.8 versus 29.8. Now, they have done a great job of growing their earnings over the last year, up 35.3%, but somehow the industry growth is 84.7%. Different for the sales. Netflix, their sales are up 15.4%, which is very good for their revenue. Industry is only up 2.6%, and analysts love this stock. They say over the next 5 years, the earnings per share growth estimate is 48.2%, about 5 times the industry at 8.2%. They still do not pay a dividend. They keep reinvesting into new businesses and keeping the business growing. Let's take a look at the balance sheet. Current ratio 1.3 versus 1.2. That's good. They got liquidity. They've done all their expansion with not much debt. Debt to equity is 0.6 versus 1.3. We do see a net profit margin for Netflix. Wow, 24.1 versus 6.8. They keep a lot of that subscription price that people put out there. We do see return on equity is 40.2 versus 20. Free cash flow is 8.9 billion versus 6.4 billion. I mean, these numbers look pretty good, but let's see what you got looking for. We got a lot of comments on this company as well.
Yeah, I mean, obviously it's a great business. It's just a matter of valuation a lot of times when it comes to Netflix. Because when you look here at the current price of $100.24, it's kind of, I'm going to say, in between. The 52-week range, low here is $82.11, and the high is $134.12. But again, the problem is that valuation, as I discussed. You got to December 2026, estimated earnings per share of $3.23. They give you a target sell price of just $53.62.
Yeah, and I love the company. I mean, I watch different shows on there, but it's still an investment. And we talked years ago about how they do the accounting, and it takes years for these things to show up. Remember, what were they doing? They were actually
amortizing the shows over long periods.
Long period of time when they just don't last that long. Because the only thing I watch on Netflix is the new stuff. I don't want to go back and watch something that's from 5 years ago. I think that's the way a lot of people are. So the accounting, and it could take many years for that to catch up with them. So
I don't know. Sometimes the old shows are good though. I go back and but we just went back and watched How I Met Your Mother. Shows from when I was growing up, because you kind of forget what happened. So sometimes I like to go back in time.
I guess other people feel that way as well. But I there's just so much new stuff coming out that why don't I watch something I've seen already when I see something I haven't seen? And
I feel like a lot of new stuff isn't good. I think Netflix produces too much stuff that is not good.
But you got Netflix, you got NBC, you've got Amazon Prime, you've got Paramount. I mean, there's, it's my way I settle down at night. I'm usually done work about 9 o'clock, and I want to spend an hour and a half, and I want to watch something new, and that's what I want to watch. So,
yeah, I mean, hey, yeah. I know there's a lot of people that they like to watch the old stuff too, though.
And a lot of people, I watch about 90 minutes of TV a day just to unwind. I know some people probably watch 3 to 4 hours.
Yeah.
So that could be different. And one that I would like to watch that's the old side is, but I have all the episodes, is Seinfeld.
Yeah.
I'd watch those again.
It's a good one.
Yeah, okay.
But what I was going to say is I do not like this acquisition.
Oh, yeah. I forgot about the acquisition. I knew there was something else big I want to talk about. Let's talk about the acquisition.
I mean, acquisition, so the way it's looking right now is Netflix will be buying, or the offer that was accepted is to just buy the studio and the streaming service. The cable channels like CNN, what other ones? TNT, they'll be spun off into their own entity still, and then Netflix would buy just, again, the studio, Warner Brothers, and the streaming service, HBO Max.
And you know what the value of CNN and TNT was, right? What they're getting that value?
Well, this is where it gets interesting. So the deal, first, I'm going to give that, is essentially $27.75 a share. Some of that does come in the form of shares in Netflix. So it's $23.25 in cash, $4.50 in the shares of Netflix stock. But this is where it's interesting. Warner Brothers is valuing the spinoff of the cable networks at $3 per share. But Paramount, who is, I'm going to say, salty, not happy about them not getting the kind of go-ahead to buy it, they say they believe the global networks are closer to $2 a share. So they think their $30 a share for the whole company is actually a better deal for shareholders, of course, than what Netflix has offered.
Yeah, and we could definitely see a fight there. And Netflix does have, about $9.2 billion in cash. And there was talk, too, that Netflix is doing this more as a defensive move, because if Paramount were to buy Warner Brothers Discovery, they could be more competition they're feeling for Netflix. So this is what I love about these big deals. There's a lot behind the scenes. I remember with Microsoft and Entertainment Arts, I think it was, that they bought and stuff. It's
Take-Two.
Take-Two, that's what it was, yeah.
Or Activision.
Activision.
No,
Activision. Yeah, one of those, Activision.
It is Activision.
Yeah, and it was just fun to watch that, go through the courts and everything, and we were right on that. They actually did have that happen. I think we made money off that because we bought Microsoft during that time.
No, we bought Activision.
Activision, that's what we bought, yeah. So we were right on that one. But same thing here. It's just going to be fun to watch, but there's a lot behind the scenes. And I'm pretty confident that what is his name? David Elson, Larry Elson. I think they'll come back with another bid.
Yeah, we'll see. I think now it's getting to this level where I don't know if it's worth. I mean, essentially $82 billion is the enterprise value. The market value of that deal is $72 billion, but the enterprise value looks at your market cap plus debt minus cash and equivalents. And Warner Brothers does have a sizable amount in debt as well. So you're essentially having to pay $82 billion for this entity.
Oh, I forgot about Warner Brothers' debt. They did have a lot of debt in their balance sheet.
So $82 billion. To me, for Netflix, a company that doesn't like to go to the box office, are they going to be changing the way they do that, or is it still going to be preserved for really their streaming audience? Netflix historically only likes to release movies in studio or in theaters for a very short time period just to qualify for awards. They don't like the traditional box office.
Right.
So if they don't go that route, that is a heck of a lot of new streaming subscriptions that you need to sell, or you're going to have to increase the prices to justify an $82 billion acquisition. And to me, they already have so many subscriptions. I don't know if you can get many more. So I just don't see the mathematics of this adding up that favorably for Netflix.
Yeah, and I think there's a lot more from this. And I do think the egos will get involved. I mean, you got, again, I talked about David Ellison, Larry Ellison, and the CEO of Warner Brothers. What's his name?
David Zaslav.
Yeah, he's another one. I mean, you get these big guys, and they want to be the winners. And
Zaslav is the biggest winner.
Oh, yeah, he wins no matter what. I don't think they're going to walk away from the table. So, and he was right on that. And it's just something that there's a lot more to go. And also, too, they said is that if they do stay with a Netflix deal, it's going to take probably at least a year and a half to get through the regulation.
So 12 to 18 months.
There we go. Yeah.
Yeah, because they still have to then wait for the spinoff to occur, and then they'd buy.
Yeah. So that's a long-term thing there. So, but I'd say watch the news. I think this is not over yet. So, should we move on to Valvoline?
Let's look at Valvoline.
Yeah, it's so hard to look at that symbol. It's VVV. It looks like a W and a V or W. It's just very hard to look at. But the Valvoline, their symbol is VVV. Now, I'm surprised, but they're in the auto and truck dealership industry. I thought it'd be more in the energy industry, but I guess because they're used for cars. They do have a little bit high on the flow side. It's 9%. We do see a PE ratio of 18.3 versus not material for the industry. Price of sales, 2.3, well above the industry at 0.5. Price to book value, also expensive for Valvoline, 11.5 versus 2.9. Price to cash flow does look better, though, 13.2 versus 14.7. And the PEG ratio, well, for Valvoline is about 2.6 versus 3, so about the same, we'll call it. Now, over the past year, Valvoline has seen their earnings increase by 2.5% when the industry was up 41%. Sales for Valvoline of 5.6%, closer to the industry at 6.5. And then the 5-year earnings per share growth estimate for Valvoline is 7.9 versus 18.4. So seems to be a decent business with some growth there. Unfortunately, now this is surprising to me. I thought this would be a company that would pay a dividend, but they do not. They do not pay a dividend at Valvoline. Taking a look at the balance sheet, current ratio, little bit on the low side, 0.7 versus 2.2. Here again, another high debt company, 4.1 versus 2.8. I will check the balance sheet as well to see if the debt is high and or the equity is very low. We do see that the net profit margin for Valvoline very good, 12.3 versus 1.8. And the return on equity, this kind of tells me probably the equity is low. Return on equity is 62.3, and then the free cash flow only $38 million versus $354 million for the industry. Chase, what do you got?
Yeah, I was gonna say, I love this company. Do you use Valvoline? Do you go?
I used to, but not because my Cadillac's getting older. I go to the dealership so I can check other things. But I used to go. I think it's the Valvoline on the corner there.
It's so easy.
Yeah,
they do a great job. And my new car gets free oil changes, and I'm like, I still might go to Valvoline because when you go to the dealership, the oil change still takes long because you got to drop it off to service. Generally, it's more impacted where you get in, you get out in like 15, 20 minutes. It's like it might be worth the $100 to make it quicker for me.
Yeah,
but. Anyways, I like the business. The question is, do you buy the stock, though? Current price here, $30.50 for Valvoline, and their ticker symbol VVV. 52-week range low here, $29.29, and the high, $41.33. So hasn't been a great year for Valvoline. It's down almost 20% over the last 12 months. Going forward, though, for the company, we go out to September 2027. Estimated earnings per share here, $1.97. Gives us a target sell price of $32.70. So I'd say it's essentially fairly valued based off of those earnings. We're not getting, less than 10% growth, essentially, on the estimated sell price to the current price. So it definitely would be a buy, especially with that balance sheet.
Yeah, and I did look at the balance sheet. The long-term debt is $1.4 billion, and that's down from $1.9 billion about 3 years ago. But the equity is low. It's $339 million, but that is up from $289 million 4 years ago. So, like this company, I think you'd have to have more of a decline in the stock to buy it. Maybe a slowdown a little bit in the economy. Again, like you, I want to like it, but this is why we look at so many companies. It's got to be perfect. You can't make an excuse to invest in a company just like, but I really like it. I don't care that the debt's kind of high. No, you can't do that. You got to say, nope, sorry, Valvoline. We got to move on and look at something else.
Yeah. No, I mean, it's definitely something you got to be disciplined with.
Yep. And that's the hard part about investing for many people. It is very emotional, and you've got to leave the emotions at the door, because if you don't, you're going to have terrible times. And for sometimes it's going to be great, but let's see. I think I have the wrong symbol. I was moving on to Weyerhaeuser. I think somebody put the wrong symbol for me, because I have WH, and that's Wyndham Hotels.
WY.
WY. Oh, okay. Somebody put the wrong symbol there. So let me put in WY. Gotta make sure. And that's important too. Always look at your symbol. Make sure you're the right one, because you'd hate to buy WH, think you're getting something else. So let's move on to Weyerhaeuser here. Their symbol is WY. Now, this is surprising. They're not a company. They're a real estate investment trust specialty because of all the lumber. Shares float 2.5%. PE ratio pretty high, 47.1 versus 52.8. Price of sales 2.2 versus 6.2. That is good. Price to book value 1.7 versus 5.6. Price to cash flow is 17.6 versus 16.8. No PEG ratio there. Unfortunately, I don't know if it's from the tariffs or the slowdown in the housing industry. Their earnings over the last year are down 37%. The industry is down 12.1%. The sales, however, they did drop, but only by 1.6%. The industry was down 3.6%. The 5-year earnings per share growth estimate for Weyerhaeuser is 7.8 versus 11.1. They do pay, I'm going to call it a decent dividend at 3.9%. However, because of the pullback in their earnings, you're using 180.4% of the earnings to pay out that dividend. We do see on the balance sheet, you've got a current ratio of 1.2 versus 1.5. Debt to equity is very good, 0.6 versus 3.4. And that's so important, because during difficult times, you don't need to pay the creditors as much, so you can kind of weather the storm. We do see a net profit margin of 4.7 versus 12.1. Return on equity, not very good, 3.5 versus 9.8. And let's see, the cash flow, free cash flow, only $89 million versus $1.4 billion. So I'm, again, not finding something on this company I really like, or this REIT that I really like, unless you got something good going forward.
Well, I just kind of find this interesting, but the company actually began operations in 1900.
Oh, wow.
So it's been around a while.
125 years. And we call it a company. And I think it used to be a company. And I want to say 5-10 years ago, I think they reclassified as a REIT because of all the lumber I think they have and all the forestry that they own.
Oh, here you go.
Okay.
They control approximately 10.4 million acres of timberlands in the U.S.
Oh, wow. That's a lot.
As well as additional public timberlands managed under long-term licenses in Canada. So, I mean, they have a lot of real estate. We'll call it that. But let's look at the numbers here for, again, Weyerhaeuser. Their ticker symbol WY, $21.69 is the current price. 52-week range, the low here, $21.16, and the high, $32.70. So it's really struggled over last year. It's actually down about 31%. Over the last 5 years, down about 28%. Over the last 10 years, let's see, it's not wanting to give me that number, unfortunately. But it looks like it's essentially about flat to slightly down over the last 10 years as well.
Yeah, last 10 years, it's up 1.8%.
There we go. And that includes a dividend.
Yeah.
Now, going forward for the company, since it is a REIT, we look at FFO, or funds from operations. We go out to December 2026, estimated FFO of $1.14. Unfortunately, gives it a target sell price of just $18.92. So it's still slightly overvalued based off that FFO. And I'm curious how much that depreciation really is, because generally we have buildings, that's what you're depreciating. But if you have lumber and land, I wouldn't think the depreciation would be as heavy.
I think there's something different with the trees, how they account for them. And to let people know, I mean, the earnings per share on the REIT is 25 cents. You said the FFO was, what, $1?
$1.14.
Because of the depreciation. And unfortunately, we can't talk about it anymore. Show's over.
But wouldn't be a buy.
No, would not be a buy. All right, thanks for listening to the Smart Investing Show. It is for information purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs or have other investment questions, feel free to call myself, Brett Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. A lot of great educational information there. Listen to the podcast, get the newsletter. Thanks for listening. We'll be back next week right here on the Smart Investing Show.